Good morning, ladies and gentlemen, Clueless 8 members. This is Frank, Clueless 8, and this is a Saturday morning free market chart analysis and um, market analysis forecasts for members. It's January 9th, 2016. The session's being recorded. It will be uploaded on the YouTube Clueless 8 channel. Highly recommend that everyone go in there and subscribe to it. So anytime anything's posted up there, you will automatically get a reminder to check it, and you do it at your own time. So very important that people subscribe to that channel. It's free. You just put it in there. It's Google, right? Full disclosure, this is purely for financial education and not for any solicitation or financial advice. So let's kick off. So what we're witnessing here is, and we've gone through these a bunch of times, history. What's new to us, and that applies to everyone, is the speed and the ferocity and the technological moves. I should say that the speed and the ferocity of the moves that's exasperated by high frequency trading programs, algorithmic machines that run the market these days. And you don't get, let me just put it this way, and I've been in the market a reasonably long time, through all these, through all these vicious moves, and all that stuff. You don't get these type of movements in this short a period ever. But over the past year or so, we have, and we'll be seeing more of these. We'll be seeing capitulative type of movements with these massive red candles. You'll be seeing these huge green candles. This is a monthly chart of the Dow Jones Industrial Average right there. And this doesn't do justice because we need to zoom in and see what's happening on a weekly basis, because these candles are happening within days, not within weeks or months. This might seem like it's a monthly thing, but ladies and gentlemen, when did the month start? It started on January 4th, last Monday. So this was from last Monday. What I try to do for myself and for my service is I try to cut as much noise out as possible. Now, we can live without noise. We can all love to live in a world of full silence where we just hear our own voices, hopefully not too many from our heads, and we love to hear our voices of our significant other, or our dog, or our cats, or our babies, and it's a lovely world. Everyone's very nice. But the world isn't like that. There's a lot of noise. So from a behavioral standpoint, we have to cut through the noise and try to see what's going on. When it comes to stock markets and financial markets, there is so much noise. I am noise. And forget the media. I mean, that's just random, like pathetic, like out of control, trying to grapple at every single thing type of noise. But that's what the media does. Their job is to report, their job is to sensationalize, and their job is to, and that's the business. Okay, so blaming the media for things is not going to do anything. So the purpose of this session, and I'll try to keep it concise because we all have stuff to do on a weekend, is to cut out as much of the noise as possible and try to see what we think, or I think what might be going on, and then you guys have to take that, process it in your head, and figure out what your feelings are about what's going on going forward. Because one of the key things I said about the video cast the other night, when I was pretty firm about it, and and I'm just reiterating in a nice, friendly way, is there is only one God. So nobody's God in this business, okay, or anything in life. So whatever religion we practice, whatever faith we believe in, the reality is that if you just follow somebody blindly, then it's going to be difficult. So what I suggest, which is very important, that I don't even follow myself blindly. If I did, I'd be sitting on on $6 million worth of profit for 2015. Believe me when I tell you that I've back tested my trades. I did very well, but I didn't make high double-digit millions. But when I back tested my my trades and my calls, because I have a record of each one of them, right? From point A to point Z, and if I was truly a mechanical robot, which I'm not, but I'm trying to be, then the returns, I am not kidding you guys. Okay, ladies and gentlemen, the returns would have been in the high millions of a reasonably moderate base of capital. You're not talking trading with $1 million just in pure trading and then bringing up to 10. I'm talking working with the risk capital that we trade with on the trading side, because it is risk capital, no question about it. Okay, making 1,000% for the year or more. So the reality of the thing is, we have to take the human factor into the picture. And despite our most valiant efforts, we fail. But the biggest failure in life is when you don't even know what your faults are. I don't want to be an evangelist priest here, but the reality is that is the truth. If we don't even know where our deficiencies are and pinpoint them, and every single day, every single hour, try to minimize it, to decimate it, then we are going to be miserable in life, and of course in this type of business of trading or investing. Hey, Mark, you there?
Yes, I'm Frank. How are you? Late, but
no,
here.
I'm glad that you're here. Thank you, sir. Thank you. That's Mark Foster, Sienna for people. So what I was talking about, Mark, a quick thing, and of course you can review this, we just started a few minutes ago, is the purpose of the session is to cut out the noise as much as possible, filter out the noise, and try to see what exactly is going on behind the scenes, which we'll never know, but at least from a chart perspective, try to be as technical as possible and as least emotional as possible. So if the lower denominator is emotions, then we like to minimize it as much as possible so that our potential, okay, let me put it this way. Let's do this, okay? Because it's important to me, it's important to ever. Imagine it's a PE ratio, except it's not price to earnings. Imagine it's a PE ratio where it's your potential divided by your emotions. How about that for PE? Okay, so if you minimize your emotions as much as possible, which believe me, I try to do every single day, and it's not easy, and you increase your potential exponentially, that's when your PE ratio goes higher. How about that? Okay, put that down somewhere. And once that goes higher, you're more attractive to your significant other, to yourself. Because the biggest challenge and competition in life is not the other person, it's you. Because all of you, including myself, I believe, are way off what our potential should be. But the minute we start doubting ourselves in any major way, that PE ratio is going to collapse very nicely. And you're not going to be attractive anymore, just like a stock isn't. When the PE ratio of a stock, the traditional way of looking at it, is high, it's overvalued. Well, why do you think it's overvalued? Because it's growing like nobody's business and everybody wants it. A PE ratio way low means nobody really cares about it, and that's why it's sitting there. Is it cheap? Sure it is. On an average term, if a growth stock has a low PE ratio, it's a bargain. And I think that's that's pretty much the readjustment process that we're going through right now. So let's hit the markets and just quick summary. I don't want to get into too much. Main causes of this drop. Well, at least the global macro causes. The first and foremost macro cause of this monumental drop in the market from 18,000 almost down to 16,000 is panic, fear, and emotion. Period. I don't give a hoot what anyone tells me. Number two is, obviously, we know the Chinese market. But keep in mind that the Chinese market alone can't do this. There is a string of hedge funds. There is a string of Susie, you just walked in? Hi, Sue, can you hear us? Okay, great. And again, reminder to Sue, you and everyone else that make sure you have a headset and a microphone next time I do this. Very, very important. Anyway, let me continue. So, so the key thing is that there's a string of hedge funds underneath the belly of the market, which have absolutely no frigging idea what they're doing, but they're leveraged to the hilt. What does that mean? It means that for every dollar, they're borrowing 9 more. And they're getting decimated. And even the bigger hedge funds can't even handle this market, and they're liquidating somewhat. All good signs. Hedge fund liquidation, if you look back at history, if you know something about history, that generally speaking, once the process runs out, it is one of the best times to invest in the market ever, because they're forced selling. Anytime you're forced to liquidate, means you don't want to let go of something. Think about what forced liquidation means. It means you'll cherish that, that car or that, that beautiful piece of whatever painting that you have, and you're forced to liquidate. So just the way the word says, forced liquidation, you have to sell it to come up with the money. Well, that's what's going on. Number two is oil. We know that. But let me ask you a question here. How many serious oil funds are still heavily invested in oil? Not many, because oil's already gone through a massive, massive downturn. So let me do this 1 second. So it's not like there's a huge pent-up demand for oil in the portfolios, and all of a sudden they're like, oh, oil's going down, so we got to sell out. No. Let me remind, this is all part of filtering the noise, okay? Oil was at $147 back in July of 2008. That is cause for concern, ladies and gentlemen. That is serious cause for concern. Here's the funny thing about life, and I don't have words for it, that oil's done a complete, this is a total, complete mathematical, and I'm not a great mathematical genius, but to me, this is as good of a negative pattern symmetry, if you want to call it that way. I'm sure there's a term for it. My son would know. He's pretty damn good in math. So where we are right now, and we are all terrified. Give me the human aspect of it. Oh my God, oil's going to 30. Well, great. I'm not kidding around. Fill my car for 20 bucks. Fill a truck up for, $10. Give it to me. When we were here, I still remember, it was panic. And then came the crash. That was this crash in the market, which we all know. Which, by the way, want to remind everyone, was not propagated by the stock market. It was propagated and triggered off by the housing market and all the derivatives of the housing market, from the mortgages that were pushed into, packaged and sold by the largest investment banks, Lehman and stuff included, Goldman Sachs, and sold to everybody around the world. So that was the cause for this drop. It's not like stocks were way out of control. Because I'll tell you one thing, market history again, that the only time that people were truly excited about the stock market, can somebody tell me when? Where brokers could pick up the phone and Mr. Jones and Mrs. Thing from Oompla, whatever, Oklahoma, would say, yes, I'm sending you $50,000. Go ahead and invest in that. I'm really excited. When was the last time that happened?
1929?
No. I'm talking recent history. Yes, you're right. I mean, that time everybody. Well, you know what 1929 was? 1929 was what China's market is. Okay, a nascent market where nobody knew what the hell they thought it was. That's China's market. It's a total gambling casino. And that's the reason it's going to be a law of diminishing returns, in the sense that more China market stumbles and stuff, the less we'll disassociate. We're going to start to disassociate from there. And real serious investors will gravitate towards more developed, structured markets like the US, primarily the European markets and such. But no, in recent history, within your lifetime, when was the last time you think people, and maybe you yourself, I mean, not you, Shani, but were completely excited about the stock market?
It was 98, 99.
Yes, thank you very much. 2000, the crash of 2000. Look, I meet a lot of people. I used to meet a lot of people. Now I'm more private, do my own thing, so I don't have clients, so it doesn't matter. So the point is that I still have a feeler of what's going on. When you walk out there, nobody asks you about stocks. The stock market is a hated entity. And believe me when I tell you. So point is that from an emotional standpoint, the stock market is certainly not somebody you would walk in there and say, hey, man, do you want to buy this market here? I mean, things are really starting to look good again. They'd be like, yeah, right. Forget it. Did you hear about what happened in China? And did you hear about, what's happened with oil? It's going to $10. This is what you hear out there. Did you hear that guy who came on TV, the guy who looks like Sonny Bono but had a lot of plastic surgery? His name is Pimco's Bill Gross. That's what I call him. He looked like Sonny Bono, Cher's ex-husband, except he shaved his mustache and had plastic surgery. He did. The guy's a frigging idiot, Bill Gross. And believe me, I'm not a big shot at all, but I've met this guy because of my old days on Wall Street, because we had seminars and stuff, and he was a great bond guy at one time when things went on his favor. Have you ever reviewed his calls on the stock market? It's the worst ever. But when markets start to get tizzy, he's all out there, and the media brings him on there because he wants to talk his book. Is he smart? Of course he's smart. He's worth hundreds of millions of dollars. What am I saying? So, but the fact is, you'll notice one other thing about the media, and I've noticed it, and there's nothing wrong with it. They will basically bring out as many bears as possible. From Mark Faber, who basically has sold everything and moved to Thailand or China. Somebody should just keep him there, to be honest with him. Okay, he's a total U.S. hater. I can't stand that. Anybody who hates the U.S. financial system for no other reason other than the fact that it's the United States financial system, in my opinion, should be shot. Shot in the sense that just banished from here. They should take his passport away, just like every other ISIS bastard. Excuse my French, I'm sorry. Okay? Because the only time, there's nothing to say. It's the same old story, but they bring him on, his fat face, all kinds of stuff. His whole thing is you buy farmland in China and you sit there. Okay, great. Do that. Okay? So all this messes. So this is all noise. A lot of noise going on. You very seldom hear rational voices. So let's talk about some of the rational voices I've heard over the last week or so. And then we'll go over the charts, okay? And if something doesn't make sense, please feel free to stop me and say, hey, okay, that's what these sessions are all about. So a couple of rational voices I heard from a technical standpoint was a trader on the Chicago Board of Option Exchange who is a VIX trader. Very important because they know a lot of the underlying stuff. Now remember one thing. The Chicago Board of Options traders are not geniuses. They're playing the flow in the market. That's what they are. They're flow traders. So it's not like they're great forecasters of, doom and gloom or euphoria and great stuff. They're going with it and they're placing their bets. Remember, everybody's placing our bets. We're placing our bets. They're placing their bets. Okay, we all know that. So the point is that one of the things that he said, and this is said on Thursday, that he's not seeing, and he used a lot of technical term, he's not seeing, and he's actually seeing a backwardation in VIX, which is very strange. In other words, in the coming months or going forward, he's actually seeing the VIX premium drop, and that real large players are believe that the market's going to be super volatile. Yeah, we know that, but not like an imminent doom of collapse of the financial system here or overseas. So the VIX premiums as such are on elevated levels. We know that the VIX closed at what, about 27, but they are not buying over the short term, mind you. Over the short term, they're not pushing up the premiums towards the 40 VIX and stuff, which we went through. Want to remember what the VIX did? Let's see if I bring this up. So you have a chart of the VIX here on the daily. The VIX spiked to 53. Spiked to 53. Can somebody tell me when? I mean, why the VIX spiked to 53 here, which lasted maybe a couple of minutes, but why? I already gave away the answer.
Flash crash.
Thank you very much. The flash crash of August 24th that I always keep on use as a reference point. The flash crash of August 24. And why did the flash crash happen? Because it was already building up, but then came a couple of sovereign wealth funds, which are wealth funds or basically large hedge funds run by countries, not individuals. Sovereign wealth fund. In this case, it was a Norwegian wealth fund, and I think it was the Dubai wealth fund, which basically capitulated. Well, they don't capitulate, lose all their money. It means they sold a chunk of their stuff. Remember, the Norwegian wealth fund is one of the most, one of the larger ones in the world. Don't forget, Norway is a very rich country, all their oil revenues. And then Dubai, and of course, we already know. So the point is, this is what happened with the flash crash. So aside from the flash crash, okay, so this is an outlier. This is an outlier. So we'll leave that out. So from a mathematical standpoint, bear with me.
Hey, Clue, can I ask you a question?
Go ahead.
When that flash crash took place, is there anything that you saw at that time that might have triggered that before it happened, or it just happened and you just
I just reacted to it by buying. I had trades put in there. I had no idea what the settlement was going to be, and it worked out pretty damn good. I wish I had put my whole kit and caboodle in there right there. Answer to your question, no, it just happened. It happened immediately as the markets opened, because no, the only thing was that Europe was selling off, right? So we actually opened, I can't remember that day, but I think we opened up a little bit and then boom. So whatever the pent up pressure was, okay, it's almost like a beer bottle exploding, okay, or something like that, whatever. So that's what happened. So it happened immediately, and that's why it was a flash crash, because systems just blocked. What I did notice that there was something very weird was if you remember that day, you can Google it. The VIX wasn't, the VIX was stuck. They couldn't. Things were just way out of whack. I saw quotes not, looking right. So that's the only other thing. But there's no way, just like anything else, just like in a quick, like a heavy duty accident, right? There's no time to react to that type of stuff. What are you going to do? Oh, I'm going to sell the flash crash and then buy the flash crash? No, it doesn't work like that. So the answer to your question is no. It's instantaneous. And with the machines, it's instantaneous, and it turned instantaneously too. Just you remember that. So let me go straight into this. So let's cut out this outlier. Let's look here. Rational thought process. I'm trying to sort of gravitate towards that, right? So on the upper end of the scale, we're almost there, 28.5. Right there. There's your band. There's your band of instability or volatility you're looking at. Okay, there's your band of VIX, volatility index, right? Just the way the name suggests, volatility index. So there it is. There it is. So ladies and gentlemen, this is the outlier. Okay, are we going to just explode up on the VIX and head towards 40 and 50 immediately? Everything in life, and all of you are very smart people. I know some of you personally. You guys are great. Okay, and you've run your own businesses. You've been successful in what you have done. Anything in life you do, you have to have an opinion or a forecast. I have mine. Right or wrong, I'll stick to it to a reasonable degree, and then I'll just panic and capitulate. How about that? Okay. But the point is, at this stage in the game, when I look back at this, we are on the last, and all other indicators are showing that. For the short term, everything is short to medium term right now. Okay. So we are on the almost on the last mile of the move on the market breakdown. In other words, a tradable bottom, a significant tradable bottom is taking place. And I'll show that in the form of the other charts that I have behind this particular screen. And if you look at the VIX, the volatility index, can we do an overshoot? Absolutely, we can do an overshoot. But I'm talking to you what will actually happen. This is a daily chart. This is your outlier. This is where it's just a one-way free fall, and it doesn't matter. You can basically shove even at the last minute when the market's down 300-400 points and say, okay, that's it. I'm going in, buying as many S&P puts as possible. Don't you think I like doing that? I love doing that, but it stops me because there's something called rationality and experience of what I've gone through that stops me for telling people just buy the crap out of the thing. I mean, short the market at that point, which you hear all the time from the media and other bears who are like I shouldn't say bears, but the hardcore ones. That this is it. This is the beginning of the end of the system. I don't know. So my point is, this is your outlier. So this is where we are. So just to, you can do this on your own screens. You look at that and look where we are. So just remember that. Let's move on. So the VIX is on the high end of the scale. For people who are new to the market, that means we are getting towards the low end of a tradable bounce in the markets. That's all I'm looking for. I don't know what's going to happen 2 months from now. I don't know which other cockroach is going to come out of the Chinese closet or the Japanese, markets. Not the Japanese markets. They're far more structured. The Chinese market is an insane casino. If you've ever been to China, if I have very good friends are Chinese. My son was in China when he was 15, teaching English in some boondocks out there in the mountains. And I'll tell you, they make for gamblers, they make the Russians look like, they're altar boys. Okay? They're serious gamblers, serious. So that's what the Chinese government is trying to control, to be honest with you. You think they don't have a reason behind what they're doing? They're trying to blow out all the leveraged, what do you call secondary and the what do you call it? The shadow banking, which lends money to invest in stocks. They're blowing them out. So it's a cleansing system that's going on, just so you know that. All right? They won't tell you that. And they're almost done with it, believe me when I tell you. So let's take a look at markets. Let's start off with the S&P. How about that? So let's do the S&P here. Going back all the way, okay? So let's go back to first give you a quick perspective on our lives, the days of our lives. Was that a soap opera one time, right? So here we are. Now, I've shown this before. I'll show it again. This is a monthly chart. This was the Armageddon lows of 666 or somewhere around there on the S&P 500, 2009, right there. It was March 9, 2009, just so you know that. And this is a very defined channel. We're right there. So we're at a pretty critical juncture. All right? We're at a very critical juncture here. Because if we break below 19, let's say, we have actually, let me just draw this. We have actually gone below that, but 1 second. $18.20. $17.52. Okay. So everyone's seeing what it was. Okay, good. Okay, there it is. Everything put in a nice, neat little picture. All right. So let's look to see this. All right. Now, forget the levels. Let's focus on the channels. We are at the lower end of the channel and slightly lower than that right now. We are engaging these two blue lines right there and right there. For people to focus here, 2150 on the S&P, and on the low end, 1902, which pretty much we're there right now. We're 1912 on the futures actually, after the market closed on Friday, and we're in the lower end of the band. We break below the band, let's say below 1862 or so. And these are not just numbers. These are very important numbers for your financial health, if you're a serious trader or a non-serious trader, and for your mental health. I'll tell you that right now. So below this, we're going to engage 1752 real fast, which also happens to be the 50-day moving average right there, this red line. And this orange line here, where we're engaging right now, if you notice, it's not a coincidence that the market went and is testing right now as we speak. This orange line here, which is the 34-day moving average. I'm a big believer of the 24 and 34 and the 50 as moving averages, and it's no coincidence that every single time we have engaged the 34 moving average here, close to it, we came close to it, we came close to it, we came close to it, we had a sizable bounce. I repeat, we had a sizable bounce. Look at it yourself. Right here was the only time that I can think of where we engaged the 34-day moving average, slipped below that, but we touched the bottom end of the channel. This was this was actually February of 2016. Very interesting. No, what am I saying? February 2000, idiot. This was October 2011, right there. October 2011, right there. So we're right at that juncture right now. So a little slippage around the 1900 level, or maybe even below, is acceptable. What is not acceptable from a standpoint of keeping the linearity or the uptrend in the market from a bull standpoint is the number 1820. We break below 1820, we're going to thump into this line here, which is the most powerful support level with the Bollinger and the 50-month moving average right there. Okay, in this case, month, so it's 50-month. And we break the 50-month moving average. We are going to 1600 so fast. And not only that, you're talking about a global mini depression. because asset values across the globe, and if you think that it's not going to hurt you, whether you are in the market or not, it will hurt you. I don't care what business you're in. Aside from doggy grooming and veterinary services and medical stuff, you are all going to get hurt. There will be job layoffs, there will be panic, and there'll be all kinds of stuff. That's the doomsday scenario, right? But here is what is going on right now. I'm looking to see what's happening in front of us without really projecting out too much. So that's your monthly chart, just so you have a picture of that. So that's cutting out the noise and just showing you exactly. We are exactly engaging the 34 moving average, and that should create a automatic reflex bounce, as I've shown. So what does a reflex bounce look like? Well, let me pull in the here's your E-minis, the guts of the S&P 500, where the true gamblers lie. How about that? All right. So at this point, the way I'm looking at it, and actually not way I'm looking at it, things I've seen happen just so many times. It's not easy at the end, but obviously creates the most viable opportunities. So hopefully all of you will take some advantage of it, as it's happening. This candle is unprecedented. You can see that. No wonder the headlines are just so blaring. The worst ever January since ever, in decades, or whatever the case may be. I don't know, but yes, it certainly is. So again, we're engaging the uptrend line, and the quickest way you can figure out what a bounce would look like is you go to the 1 hour chart, you look to see what the most recent sell-off was. Okay, so you can do it in different time frames. So please indulge me to show you. All right, so I'm getting all these lines out for now. Hide drawings, price levels. So the most recent sell-off, let's start off with the most recent. The most recent sell-off started here. This was that reversal on Friday, right? We're doing great, and then bang. See you later. And I did post, and I want to be clear on that take some decent profits off the table. I managed to get out of a decent amount of profits. I still held on some, so it's a beautiful red day, right? But this is how you do it. Then you go, let's say you go, so the high was Friday, so you go to the 5 minute, and you highlight it, right? Right there. Man, things are moving so fast. It's like from 1965, we're bound to 1900s. History moves fast when you have machines running the world. All right, believe me when I tell you. So you hit your Fibonacci retracements, real simple. Put it up here, pull it down here, gently. Put it right there, not that hard, right there. So if you want to see a retracement, you want to see where it goes from 0 all the way up. You want to see a pullback, then obviously you do it from the top down, right? So what are we looking at for retracements? What we're looking at for very quick, fast retracements, and I'm going to do it in different time frames. On the S&P 500, the first engagement is your 23.6 fib, which also happens to be the 34 moving average. This is a 5 minute chart, obviously. 34 moving average, bingo. The next one, which is the 38.2, was the point of breakdown that was around 3 o'clock, right? Around 3 o'clock on Friday. That's when the hardcore $50-100 million sellout started happening, right? You guys heard about the 1.4 billion to sell. Well, what do you think 1.4 billion to sell? It was like somebody decided and woke up and said, "Oh, market's really bad, I'm going to sell." No, it's very large, concentrated hedge funds being portions of it being liquidated because of margin calls. If anyone's gone through a margin call, and I've been in business for a long time, believe me when I tell you, it is not fun when they're liquidating it. But that's just the way it is. You don't send in the money, we'll liquidate you. That's what margin clerks do. And institutional margin clerks do it, obviously, in the millions, right? Retail will do it in the thousands. They don't want to hold things over Monday. They just want to clean out their books, close their books, go home and start drinking. Right? That's what margin clerks, they're the worst investors in the world to start with. They don't even give a crap about the market. They just want to sell things. That's it. That's what they do. That's their job. Collect money and sell things. They're like they're like a collection agency. So bottom line is that you got the 50-day moving 50 fib moving average, which generally is where a bounce, you go for a big bounce. Okay, a 50% retracement, I've seen it over and over and over again, almost happens 90% of the time, and I've showed that throughout my service also, since 2014, April 2014, since I started it. So 50% retracement. A full retracement is 1964. Forget about full retracements. Looking at short-term stuff, 1930. So that's roughly about 20 points. Remember, S&Ps normally like moving in 20-point increments. If you want to be a trader, you should know these things. They like moving in 10 points, 20 points, 30 and 40 are more like outliers. So stuff when we see like S&P down 40 points, those are way off the bell curve, okay? So those are not the norm. Machines are no machine. Those are not the norm, all right? 10, 20 S&P points, yes. 10 points S&P is roughly about 70 to 80 Dow points. 20-point S&P down or up is, multiplied by a factor of 6 or 7 is 120 to 140 Dow points. Roughly speaking, that's how it works. Anything beyond that, that's the outliers that I just explained to you. So last week was certainly an outlier week. But saying all that, so that's your first immediate, quick, fast traders would basically be selling here at 1923. A retest of 1900 is likely, and then we see what happens. Remember, we're engaging a long-term channel, which I showed you guys before. So there's going to be some massive support there. It's just the way things work. So that's it. Now, your 50 retracement is 1940. You want to see what happens beyond that. Now, remember, this is just Friday. This is not the whole week. This is just Friday. So let's go back to the 30-minute and do this. Pointer. We grab this little Mr. Fibonacci here by his ears, and we drag it to up here. This, ladies and gentlemen, is more reflective of what will happen this week. So I'm just laying out the roadmap for you. All this is predicated on the fact that there are no other large black swans, not little ones, or burnt Peking duck, as I like to call it, because that's what happened this week, right? It wasn't black swans. It was the Chinese regulators, stock regulators, served as burnt Peking duck. So all kidding aside, this is what you'll see. Here's pure machine-driven trading. You are going to see the retracement bounce here, 1950, this week. 1950 to from 1910, you're talking about 30 points, right? 30 to 40 points. So you're talking about a 200-point rally, 240-point rally. Don't forget. Can somebody tell me how many points we dropped this week alone on the Dow from Monday? Take a guess. Take a guess and tell me, because that's a key important part of trading, which is quick blink thinking, just like right or wrong. It's just whatever comes to your mind. Like, what do you think? Can somebody tell me without
1,000 points.
Okay, somebody else.
700.
No one else? Always?
$600.
Somebody else?
600.
Okay, no, that's good. And somebody else? This is important. This engagement between me and all of you guys, we're all in the same boat. I mean, so it's important, and I'll explain the reason why. It's all the behavioral game theory stuff, and I'm not getting around. So go ahead. Perception is very, very important. So don't look it up. Really, force yourself not to, cheat, and just tell me.
800 plus points.
Okay, some other people who hasn't answered. Oh, somebody might be typing in. Okay, Suzanne said 1,000. Sorry, I didn't see that. Roger said 900. Okay, so let me ask you the second question. Monday was, what date was Monday? Let me see here. The 4th, right? Of course, it was the 4th. I'm giving you the exact number. Now, before I give you that exact number, did it, to me, despite all the twists and turns, and I was doing great till like Wednesday, and then Thursday kind of managed, and Friday like got slapped. So point is, through all that, did it feel like 1,000 points? Let me, and I want an honest answer from each one of you. Did it feel like 1,000 points, or did it feel worse? Whether or not you were in the market. I know if you're in the market, it's a different story, but I'm talking about, did it feel, and it's a simple answer, did it feel like 1,000 points, or did it feel far worse?
Far worse.
Thank
Far
you.
worse.
Okay, always said far worse, right? Okay,
Yeah.
far worse, right? Exactly. That is what I'm getting at. It felt far worse. So looking at my, holy cow, I was even wrong. I thought it was 1,100 points. Ladies and gentlemen, even though it was far worse, and this is very important, this is human psychology, we try to blunt that move by thinking, oh, it's 600 points, which is 600 points. I will take 600 points in 5 minutes and run with it. If this number is correct, I thought it was 1,100. It was 1,408 points. It was 1,408 points. And I want to short the market here, like in a meaningful way. Am I out of my mind? Yeah, I guess I am, actually. That's why I do this business. 1,400 points, guys, in one frigging week. And here it is behind you. Ah, come on. So 17,721 Monday, Tuesday, Wednesday, Thursday. No, this was Monday alone. This was Monday, and this was what? This was the 8th. Okay, so 1, 2, 3, 4, 5, 6, 7. Yeah. Well, 7. Well, part of it was the day. But anyway, we dropped from 17,000 whatever right here, okay, to here. That's roughly 1,400 points. To 16,300 to 17,700 at 1,400 points. Look, I'm sorry. That is humongous. So let's try to see when the last time this happened. It didn't. I wouldn't be surprised, to be honest with you, that we drop another 340 points and test this 16,000 level and just like say, okay, that's it. Nobody will hit the market. Nobody will touch the market. Okay, only tactical, really, people like you who are like actually spending time on a Saturday morning looking at. It's almost like being in battle. Like the next day you assess the damage and set your strategy, right? So that's basically what you guys are doing. I'm doing. So the point is that here's my point here. From a standpoint of this is what's going on right now. Are we getting oversold? We're getting deep oversold to the point where a lot of bargains are starting to appear in many cases. Now, I'm not just talking about the energy patch. So here we are with the Dow. So let's do a Fib retracement on the Dow. I haven't finished on the S&P either, but let me try it. So here was 17,747 when? Last Tuesday. Let's start off with Monday. And you can write these down. This video will be open for all of you. Oh, wow. I need to get to Monday. This is not even Monday. Hold on. Where was Monday? Oh, here was Monday. Okay, Monday started here with a bang. All right. Okay. So we have dropped 1,400 points or so. Actually, it says 1,100 here. I don't know why the other one showed different. Well, 1,100 to 1,400 points, whatever the case may be. It says here 14, 17, 45. Okay, the 3-1. So let's say 1,100 points. All right. So here's your fib retracement chart, and it will work. These levels work almost 80 to 90% of the time, just based on what I've seen. Are we going to retrace back the full 1,000 points this week? I don't think so. But what do I know? I used to say, and I still say, more violent the downside, the more violent the upside. Every action has an equal and opposite reaction. Ask Mr. Newton. It's true. Pattern symmetry does work, except during pure panic, which is now. So, retracement levels, right there, you're seeing it, 16,573 and possibly 16,867, 869. That's your 50% fib retracement, which has a very high accuracy rate. However, going into it a little bit more, the point of the volatility cluster was primarily in this zone, as you can see it. Right in this zone. So that zone was 17,000 to 17,186. And that's when all hell broke loose, right? Right there. Gap downs. You don't see this type of gap downs like this, believe me. But then I haven't seen a lot of things. So gap up because of the jobs data. And then the margin sell-off that started here at pretty much around 1 o'clock. And then at 3 o'clock. Just dissecting all the noise out, telling you that this way things work. It's not like at 3 o'clock some other news came out that was terrible. It was just a flow of things. All right. So here are your retracement levels. Best case scenario is your 50% retracement level, 16,867 on the Dow, 17,000 if things really, are on, really there's something big comes out. China makes some big structural reform, all kinds of stuff. Numbers show up and not as bad, which reminds me of a very important thing. Talking about noise. The noise was so thick with the smoke of shrapnel hitting the market, right? That there was a couple of pieces of very powerful news that came out of Europe, including some growth numbers which showed some positive moves. That Europe is not completely falling into deflation and into recession. Things were actually getting better, but all of them get swept under the rugs. Things I've learned over the years. During good times, anything that's bad gets swept under. During rough times, anything that good comes. It happens in our lives too. It's swept under the rug. So no one talked about those at all, but it's there. Posted on Twitter, the German number was good. Italy's numbers were very strong. France was flat to slightly down, but not as bad. Under normal circumstances, those would be looked on as very powerful thing that things are starting to work in Europe and falling into place. Anyway, so there's your retracement levels that I'm looking at. Now let's go back to the S&P 500 and show you one other stuff. Right there, okay? Just a reminder. That's your 61.8. That was your sort of trading range for after the China drop. Another mini trading range, if you notice. Then the other drop. There was no trading range here. It was flat down. And there's a minor trading range here, which gave in at this point. So before I leave this chart, from 16,300 or so. Going up 200 points, 273 points, or 400 points, as you can see beforehand, doesn't seem like much given the magnitude of the crash. Correct? Correct. When you look at this visually, forget it. Let's say you know nothing about the Dow Jones. So look at this visually. It doesn't seem much. If I showed somebody who had no idea about the market, like a lot of the idiots on TV, just kidding. What do you call? And said, okay, we're gonna bounce up here. They'd be like, yeah, so what? We were all the way up here. So here's what I'm getting at: that because of the magnitude of the drop, 200, 300, 400 point moves still leave a significant amount of room, but more importantly, will not be felt by most people out there, but certainly felt by tactical traders. I want to be clear about that, because these are significant opportunities to make back on certain trading positions which are underwater. Not just make back, make above. I don't go into something. I try to program my brain that way, saying, oh, I'm just going to make it back. If that's the way, then I'm going to be spinning the wheel at the same position all my life, just trying to make back something. No, you have to go well beyond that. That's the attitude you need to have when you attack a trade or anything else you attack in your life. Well, I don't want to get into that. Okay. So the point is, it's not just about making back. It's about moving forward. So some traders will tell you, some really good ones actually, who never appear, will tell you that the point of maximum aggression is not at 18,000 Dow. The point of maximum aggression, given technicals and stuff falling into place, somewhat falling into place. Because by the time they totally fall into place, it's too late. Too late meaning it's going to be up here. So we're just doing the early read that you have to be the most aggressive at these levels. Do traders practice it, or human traders practice it? Absolutely not. Believe me, they don't. And I'm not going to sit here and berate, and just say, oh, you should do it and stuff. That's up to you. This is the point of maximum aggression, give or take some volatility at this level, because the move, which is going to be short and swift, is going to be powerful. It's a reflex bounce. And that's where most of the money will be made. I've shown this repeatedly. One of my many frustrations was on the video cast that I did the other day, where I laid down the strict rules that is the fact that part of my service is, of course, talking about behavioral game theory and stuff and all that, but it's wearing me down as a person, trying to really motivate people and show them what I think works very well, but doesn't always work that minute. So people who are willing to accept it, they'll run with it, but, like I said, and the people who are not, let them do what they need to do. So bottom line is that the point of maximum aggression, give or take another 100, 200 points, whatever, is here. Because this will be the bounce point. And I've showed that on the long-term charts. And then after that, you do what you need to do. Now let's take a look at bear with me.
Hey, Frank, this is a question.
Yes, of course.
When it's down at those levels,
yes,
who tends to be the ones that's coming in and buying them? Is it the institutionals, the algos?
Yes, remember the algos are a very good question. The algos, I didn't want to cut you off. The algos are run by institutions, right? So algos are run by institutions. So there's two parts to that question. The answer. The first part is that the machines start buying. They just start buying because they have certain predetermined levels that they see the market going, and that's one of the reasons why if you look back, excuse me, at my work from years, and I need to really archive them at one point, just for myself to study, you'll see that a lot of the time, especially in the past year or two, that I've drawn charts, and the markets have exactly bounced from there. And even since for example, your involvement with the service, you have seen that happen repeatedly. Now, I don't know why, but maybe I'm drawing things in certain ways and looking things in certain ways. Forget the fundamental stuff. I'm talking technically speaking, where the machines are also programmed to do that. Now remember, algos come in all different sizes and forms. So they are not all algos are saying, oh, this is the time to buy. Some of them will go short there again. So yes, in answer to your question, it's institutions, but institutions can be painted with one brush. A lot of institutions are very stupid. It's primarily the shorts who are the smartest guys in town, and these are the hidden shorts. They cover first. That's why you get that big hammer reversal. That big hammer reversal, when you see those, okay, as we saw them during the flash crash, came about because the shorts covered. Okay, right there. This was a huge hammer reversal. Then this was, all kinds of stuff. So those are the shorts covering because it's just like longs. You're up a gazillion points. Like I kept on telling people, like you got fat profits, take some. And I get a whole bunch of guys coming and say, "Oh, I should be buying here." No, you take profits. So point is, just the way when you're up on paper, and let's say you did a small trade and it's up 120%. Forget 400%, like 120%, 130%. You're like, "Oh no, it's going up 300%." It's the same thing on the opposite. So what happens? All of a sudden, big sell program comes in. You're not only up to 120%, you're down 120%. Or you have stops. You are out there with a loss, and you're sitting there saying, "How long can I live this dream of being an idiot?" I've done that, and most of you have done that a lot. Believe me when I tell you. So point is, the shorts do the same thing. The smart shorts say, "You know what? I'm up 100%. Let me take my profits off the table." Therein, you get this reversal bounce. And then the buyers come in. I mean, then the sort of the smart money starts to coming in hard. The smart money joins the short crowd when they're covering. Does everyone understand that?
Well, doesn't also, Frank, that once the shorts cover, they got to buy twice. They got to cover their shorts and then turn around and buy a long position. So they're really buying twice.
No, I mean, why should they be? Yeah, but why should they be buying a long position if they're naked short?
Yeah, but I mean, they still got to cover their position. Now they think the market's going to run. They want to get involved in it, so they got to buy it twice.
You got a good point. I mean, not necessarily twice, but it is kind of a double print at times. You know what I'm saying? Because when you're buying, you're making your position whole and taking your profits off the table. It's like, you bought something at 100, you sold something at 100, and then you're covering here at 50, you're taking your $50 profit. So right there, you're already doing your buying. But that itself, I understand what you're saying, is putting a squeeze on the thing, because the market maker at that point has to go there and deliver that order. Yes. So answer to your question, the shorts cover, the smart money is right behind them, because the long only funds, remember, mutual funds in the United States of America are almost 99% long only, or 90% long. Otherwise, they stay in cash or they're long only. It's in their charter. So, and then the hedge funds join in, and then of course the tactical traders. We mean nothing to the market. Our money. You're talking about, you're talking about the real money that comes in and goes. So that's why aggression at the bottom is key. But because the machines are so fast, if you don't act like right there, how many times have I looked at a trade? I blinked at it twice in 10 seconds, and it's run away from me. I mean, literally run away, meaning that if I said, okay, like a Tesla, for example, all right, I'm looking at it, like whatever the case may be, let's say like 208, 209, within seconds, it's at 214. So the machines are way too fast. Now, does it stay at 214? By the time somebody's putting an order at 214, they'll drop it down to 212. And then if the chart pattern looks okay in the normal circumstances, not what we went through last week, then it's going to climb higher. So that's just one of those things. So I try to put up those tactical charts as quickly as possible, with the caveat that you have to be watching your own. I'm talking to everyone, watching your own in order to act. Because by the time, this is not like I'm delivering pizza, where it's like, okay, delivery pizza, you order pizza in 1 nanosecond, your pizza arrives. No. It's like by the time your pizza gets delivered, it might be too late. So just remember that. That's just trading. So there's good money to be made on that, but you have to act fast. So all right, so on the E-minis, this is not, oh, let me just show you this. This struck me the other day. Actually, I'll show this on the S&P. Forget the pattern, and we already covered that stuff. All right. Now, this is pretty incredible, and it has to do with standard deviation, right? How far have you moved away from the mean? This is pure mathematical. Forget about anything else. This is pure mathematical stuff. So I'm removing all the drawings or hiding it. And this always works. Exactly at what time it'll come, I don't know, but it'll be the same story this week. And then they'll sell over the levels that I've mentioned. Okay. So from a standpoint of the S&P 500, and I'm doing a Fibonacci retracement here from the 2135 level down to the flash crash. Okay, right there. Actually, I should just do it from, bear with me. Let me just move this. If anybody has any question while I'm putting these charts together, then feel free to ask me, because
I got a.
Sure,
Sorry,
sure.
I have another question.
No, yeah.
Sometimes you use the SPX chart, and sometimes you use the E-mini. What chooses you to use the difference between the two?
Okay. The E-minis are obviously they're pretty good. Obviously, E-minis are E-minis. There's obviously the SPX is generally traded in cash, right? The E-minis are traded. Let's put it this way: the futures market will always move faster. I constantly watch both of them, and the reason I show both of them because the E-minis during volatility periods that we're going through right now. And who's this, Corey?
Yes, sir.
Oh, okay, good. So during volatility periods right now, the E-minis on an intraday basis give me a better direction than the S&P because I can actually see the movements very, very fast. Remember one thing, on certain days when volume's light or very heavy, whatever, the E-minis are clearer and more truthful about their intentions because the futures are never traded in dark pools. In other words, they're always traded in a transparent marketplace where we can see it. Do you follow what I'm saying?
Yes, sir.
With the rest of the stuff, whether it's stock or not, a lot of them, as I've explained to you all before, are traded away from our eyes, from the public eye. So if Goldman Sachs wants to buy or dump a million shares of Netflix, they're not always going to do it in the public market. They're going to do it in the private market known as the dark pools. Okay? So the E-minis, and the simple answer to the E-minis, they're very transparent, and I study them constantly, both the volume and patterns and stuff during the day. So very important to follow the futures chart, especially in volatile market during the day. Following the SPYs and SPX are great for looking at general direction, but if you really need to know why the markets are doing certain things at certain hours during the day, then look at the E-minis. All right? So that's why.
Thank you, sir.
No problem. So looking at this here, I'm going to look at this level here, the 2114 level. I'm still giving myself a little bit of I'm being generous here with these levels, but still 50% retracement is 1985 right there. And then of course we are at the 23.6 retracement. Is it possible that we get down to 1860? Absolutely. Is it possible we do it this week? At least from the pattern, it shows we might. But I still think there is given the other charts that I showed you on the channels and stuff, I believe that once it bounces, then it can start to get towards moving and testing the 1860 lows on the S&P 500. So bounce wise, here is something to keep in mind. Standard deviation away from the moving average. Always look at these 34 and the 50-day moving averages or whatever you guys use, but still, I'm looking at the 34 and 50 because that's where my strength lies. I always look at them as moving highways. So of course, this is over a shorter time frame, and the highways have been quite twisty. But generally speaking, this is your pathway that you're traveling. If you notice the red line here and the slightly downward sloping 34-day moving average, there is the road, the highway that you travel in. Just the way we were traveling on this highway, volatility in a band, and then we fell apart during the flash crash, right? So as we're crossing the highway, look where we are right now. The distance traveled from the highway away, and I'm making this in kindergarten language, okay? The standard deviation right now is not as large as this for sure. This was like a -9 from what I understood and read in real technical lingo. This is like a -7. Like they say in New York, dude, don't push it. All right? Seriously, just don't push it. Because -7 standard deviation from the moving averages, that's pretty big. So you gotta have a tradable bounce. Repeat, tradable bounce, unless we have a flash crash, which would bring us down here. Okay. So generally speaking, the norm standard deviation away from the moving averages is somewhere in the -4 range. The depth of this is -7, and this was -9. All right. So what I'm getting at is has to be considered. The second thing, which I noticed, and these are just observations, take it, people can take it for what it's worth, is on the daily chart, despite this huge thump and the carnage, I expected more damage to the 34 and 50 moving averages. I expected far more damage. I expected something like this. I expected the moving averages to crack, like it cracked here, it crossed down, right? Where the 50 and the 34 cross below. If we're down here, we're down here now. Okay? So I expected this to be lower because of the ferocity of the move. Don't know why. I'll give you reasoning why. I don't know. Is the credit markets in general, the credit default swaps, which I'm not going to get into right now. Basically, the risk premium insurance you buy on the credit markets, which are the real iceberg underneath the surface. Above the surface are stocks. Below that is the credit markets. Whether it be government defaults, whether it be sovereign credits, whether it be corporate credit, they didn't really suffer that much this week. How weird. You'd think with the world ending, you'd expect the credit default swaps, the insurance premiums to boom, run. Go see The Big Short. You'll know what credit default swaps are. CDOs and CMOs and stuff, all stuff. You buy, so that didn't happen. Even the government bond yields didn't collapse. In other words, like I explained on one of the video casts, which you all should know by now, that during crisis, safe haven buying is key. What is safe haven buying? One, jumping under your bed. No, I'm just kidding. What do you call buying the US dollar as a reserve currency? Safety. Dollar is still king and will remain king. Believe me when I tell you. And if the Chinese keep on devaluing their currency, trust me, the only country that accepts Chinese as a legal tender is Zimbabwe. So good luck. All right, as an exchange currency. So, so number one is the US dollar, safe haven buying. Number two is treasury. Everyone shoves the big money, the big billions and trillions of capital. They go hide in the US treasury market. The 10-year bond, the 1-year, paper, all that stuff. Look, I have the 10-year, the TLT. I'm sorry, the TNX on my side. The 10-year bond budged, but nothing crazy. Budged meaning if that much money was going in there to hide because they're expecting complete collapse of the financial system, like happened in 2008 and 9, you see the bond deals, the money flowing in, and the bond deals drop like a rock. Obviously, demand for treasuries goes up, yields drop. Didn't happen, and this was talked about across the board. You can read, if you read the financial publications, they'll talk about it too. So So in other words, was this a complete pure stock thing? Great. That's good. And why is it good? It's very simple. Because if you have a collapse in the credit markets, like the junk bond default and stuff like that, in a big way, we'll see you later. Then we are talking about Dow 15,000. Okay? Just letting you know. I mean, I'm talking soon. Is it happening? I don't know, but it didn't happen on the surface this time. So the standard deviation thing has to be taken into account. So reversal bounces, generally speaking, we are way out of the Bollinger. Okay, here, and this doesn't happen either. Anytime you fall way out of the Bollinger, you bounce into the band. That's it, rule of the thumb. Just the way it works. You fell completely out of it, you bounced into it. So here is your acceleration band. Here's your Bollinger. We're completely out of the Bollinger. We're in fact out of the acceleration band. That's panic. That's me feeling like crap after I close the market on Friday. That's all of us, okay? So the bottom line is that again, a bounce is likely. What they do after the bounce is a different story. So that's it. Now, so that's pretty much it. I don't want to drag on because these are things that you can talk on for hours. I'll entertain a question or two, and we'll certainly go from there. So shoot, because I gotta wrap up in the next couple of minutes.
Frank, it's Corey again.
Sure.
When do you think at the point where they get a lot of pain to where, such as 401ks, that people panic and start taking their money out of the market, which also causes it to drop further, or you think it's just...
Sure. No, the answer to your question, everyone has a point of maximum pain, right? But the point is that maximum pain is already happening. A lot of people who put money in their 401ks, they have already called up their 401k administrators and asked them to put their stock funds into cash. My first job was with Putnam Investments. And I remember as I was working my way, starting off right from the bottom, dealing with a lot of retail and institutional clients, and you get a lot of these calls during market panic, as we've been going through, by the way. And they say, hey, I'm a little bit worried about the market, so really worried about what's going on here. And can you just, exchange my Voyager fund, whatever, which was their aggressive growth fund, into the money market account for now. I'll come back when things are okay. The famous last words. So that's already happening, Corey. So in answer to your question, that's already happened. We have some of the largest cash levels in the market right now sitting in money market accounts, not in your bank, well, that too, but in mutual funds. The outflows have been huge. They don't take money out of the fund. 401k people don't call up and say, oh yeah, let me just grab my 401k. I just want to put it in my shoebox under my bed. People don't do that. They just call their 401k administrators up and go and say, okay, I'm reallocating into the thing. A lot of people don't do that anymore. They just let the whoever the administrators, the fund managers are, handle it. So that's the answer to your question.
Thanks.
Yeah, not a problem. As in the scenario that you're talking about, where they just say, that's it, what 401k, forget about it, I'm just taking this money, that's it, is obviously the different type of story. Americans, regardless of how stupid we get sometimes, or Canadians, how stupid we get sometimes, as second cousins, our Canadian brothers, we normally don't go that crazy. China, it's a different story. China is a different story. Anyone else? No one? Okay. So listen, gotta go help the wife. We got a whole bunch of stuff going on, and I'm going to put this upload this video. I think it's pretty explanatory on what's going on, and like I said, I thrive on feeling stressed. I don't know if that makes sense. Okay, I'm pretty, normal guy, and these are the times which really test the patience. It tests the mechanics of all the things that don't work at the time that we want it to work. All kinds of stuff, and it's exhausting. But I'm glad you guys are all there. I'm glad that we share our thoughts during the day. And I'll do my best. But honestly speaking, this is not the end of the world. Believe me when I tell you. If I saw so many other credit metrics falling apart, then I would basically tell people, don't even bother. So I'm actually even telling people, as you know, that look, if you can't actively look at certain things or whatever, just follow some of these swing projections that I've made. You can work off those. So but as in point by point, what the market's doing in intraday, it's a different story.
Do you, Frank? Sorry to bother you one last time. Do you think, I know you don't have a crystal ball, but let's assume we go back. Let's assume we go back and trace Friday, and if that margin call never happened, Friday might have been up towards the end, right? You think that was sort of the collateral damage that caused the market to fall?
Corey, that's the smartest question and you have in this session, and appreciate you asking that. And you're absolutely correct. You're absolutely correct. If that big block and this is the part of the market that really pisses me off, and I can't do anything about it. Neither can anybody. Market is so frigging manipulated. It's not even funny. I mean, the way they manipulated the market, in my opinion, this is where sort of my politician self comes in. It is completely illegal. They should be shot. Because you think it's just the machines? I mean, come on. It's the way they swiped it up. Of course, we're tactical traders. Oh yeah, take some profits there. What about the somebody who came in and said, hey, numbers are good, let me buy something? They were unduly punished. An average investor. We never think about the average investor. The average investor comes in and buys some stock, and he looks back and he goes, what the, and his belief and his faith and his trust in the financial markets diminishes. This has been going on for years. And machines, when they do this, Corey, I know there's a lot of underlying support to control these, not vapid, okay? These vapid hyenas, which are algo HFT programs, some of them, because they do all kinds of illegal manipulation, in my opinion, to show prices here, show prices there, take mom and pop's money and then just grab it and steal it. That's what they do. That's what they do. So yes, that would have happened. On the flip side, on the opportunity side, like they say, you're right. In every crisis, there's an opportunity. That's an old Chinese saying. And which really applies. That it's good they did that at the end of the day, because they flushed out a good amount of the stuff, and they wanted to do that flush, I believe, manipulative or not, Corey, because they didn't want to carry that margin baggage over the weekend. You got it? So that a lot of that pent up pressure to just go boom, to let it out, happened. So that, to me, and I'm saying this from experience, I'm not saying it's going to be exactly the case this time, but what a good portion of that was taken out. They just chopped it. Because a lot of these funds and stuff didn't pay for it. These hedge funds, who are playing with leverage, they didn't pay up. They didn't, the last minute 3 p.m. call, like, hey, is the money in? No, it's not in. Well, see you later. Boom. The margin clerk just hits the sell button. He's already got what he's going to sell, and boom, it falls. That's pretty much what happened. So in a way, it's good that they did that. Because if we were up, let's say huge at the end, there could be two scenarios on Monday. They would sell the Monday open right away. I want a soft Monday open with a gradual recovery towards the level that we talked about. So that would be the perfect scenario. A soft Monday open, soft meaning down, and a gradual recovery where some sanity comes back. So that's basically it. I don't want a 300-point open, in which case I'll sell. Boom. If you get the things, you just sell and then you regroup. But I'd rather see a soft opening and a gradual recovery as we go towards the thing. Last thing I got to say before I got to run, and this is really important. What is next Friday?
Option expiration, the LEAPS month.
It is the monthly options expiration.
Yep.
Monthly options expiration is almost at around plus minus 24 hours. I mean, obviously minus, the day or so before or whatever. You get a big upside move. At this point, the put call ratio, I look at the call put ratio, just so you guys know that. The call put ratio, which anybody can subscribe to it, it's free. Go on isee.com. That's on the CBOE. Okay, isee.com. Just put in an email. You get it at 4:15 every day. It's the inverse of the put call. The call put ratio is at the lowest level. In other words, everybody, I mean, not everybody, some floor traders and institutions are heavy short. So if they still haven't covered, what happens if we get a small burp? Goes back to that big short covering rally that can be expected. All right, so that's, so the put call ratio is high, and the call put ratio, number of calls bought versus number of puts bought, is at the lowest level in months. So we're nearing the bottoming is a process. We're nearing it there. All right. So that's it. All right. So listen, thank you for listening. Appreciate everyone who was here. What we go through, I'm not making this up. I go through it too. All right, and we're all learning, and we'll move from there. And I'll be doing a pre-market AM report on Monday morning. This will suffice as the end of the week report. I will put some charts and stuff up tomorrow evening, but the Monday morning I'll do one because then I'll have a better idea of what's going on. All right. So have a great one. Thank you and enjoy your weekend. Rest up. It's going to be
Thanks, Frank.
busy week, but I expect I expect what I just explained. All right. Take care, Mark. Thank you.
Thanks, guys.